Hi, this is Diane Lim. I'm Director of Outreach and Senior Advisor at the Penn Wharton Budget Model, and today I'm going to talk about, do deficits still matter in an era of low interest rates? This is a supplemental lesson that's part of our PWBM Certificate program for policy professionals. I'm going to start by going back to a few questions that I posed at the beginning of our first lecture in the certificate program that was on the economics of tax and spending policies. Because the role and the effectiveness of tax or spending policies are going to depend on the condition we're trying to treat and how effective the treatment is to those conditions. So we should ask and answer these questions. First, where are we stuck in the economy? Are we stuck because we're limited by the supply side capacity of the economy? Or are we in a recessionary economy where our limiting constraint is the lack of demand for the production that our existing supply side capacity can provide? Second, given those places where we're stuck in the economy, where does the money from the policy land and what does it do once it lands there? And three, and this is what I'm going to emphasize in today's talk, is where does that money come from? Or what does the money that's raised by the policy do? So if we're talking about a tax policy, what do we do with the revenue that's raised? If we're talking about a spending policy, where do we come up with the money to pay for it? And we're going to focus on this financing question today. So first, kind of a broad overview of when deficit financing is okay and even helpful, and when is it harmful. So an easy way to think about it is that the answer depends on where the constraint is in the economy. If we have a low demand economy where we have a lot of idle resources, and therefore the economic goal of policies are to stimulate demand, then deficit financing is helpful because it brings consumption forward in time ahead of income, which helps to increase current consumption and decrease saving. It's good for increasing or stimulating the demand side of the economy in a recessionary economy. However, if the economy is at full employment, in other words, if most of our workers, most of our capital is occupied already producing things, then really the goal is to increase economic output by increasing the size of our productive capacity. And if that's the goal, then deficit financing is harmful because deficits are dollar for dollar negative public saving for the uncertain prospect of what will happen to private saving. So it's not an even swap. It's not just taking a dollar out of public saving and increasing private saving dollar for dollar, because recipients of the tax cut or the spending program can decide what to do with that dollar. They're not necessarily going to save it all. They might consume it. And so national saving will decrease if private saving doesn't increase by the same dollar amount that public savings decrease and the deficits are increasing. And that will imply less national saving, which implies less capital stock is carried over to the future, which is bad for the supply side or the productive capacity of the economy. So I would note that Penn Wharton budget models focus on the supply side of the economy, and the longer term effects of policies on the supply side. So the ultimate economic cost of government borrowing, like the reason why borrowing and deficit financing is a big deal for the supply side of the economy, is that there are explicit net costs even within the 10-year budget window, but those are tiny relative to the opportunity cost of the principal that's borrowed. In other words, deficit financing today means that we're choosing to spend future resources or dedicate future resources to consumption today, which means that it's not available for consumption tomorrow or for other uses tomorrow. So these are the opportunity costs. These are missed opportunities that the funds might have otherwise paid for. And because of that shifting in resources, future resources to current consumption, it amounts to an intergenerational transfer of wealth from younger generations, the future, to older generations, the present. And it implies that deficits are bad for the longer-term productive capacity or supply side of the economy, even if they might have a beneficial effect for shorter-term consumption or income. So even if we were in a recessionary economy where stimulus policy is desirable, we have to recognize that there's a longer-term cost of that. There's a shorter-term benefit if we're really trying to stimulate demand. Deficit financing is good for that. But on the other hand, if it's a large amount of money and we're using it to boost current consumption, It means that much of that activity will be consumed away today. The resources will be consumed away today and not be around in the future. And that means they're not contributing to the productive capacity over the longer term. I'd like to take a little walk through history today and just talk about how the relationship between deficits and interest rates has changed over time, and whether that means anything about, do we not have to worry about deficits anymore because we haven't seen an adverse effect of deficits on interest rates like we may have had seen in the past. So here's just a historical chart from 1969 out to the end of the current 10-year budget window, out to 2029, put out by the Congressional Budget Office. And the red line shows spending or outlays, and the blue line shows revenues. And what this chart shows is that we've almost always run deficits going back to 1969, with the exception of the end of the 1990s, end of the Clinton administration, when we actually were running surpluses because we had raised taxes and we had also managed to cut spending. Those surpluses quickly turned back to deficits, however. In the early part of the Bush administration, George W. Bush administration, when we passed tax cuts, we had a war, we had a new Medicare program, which I'll talk about in a minute, and we had a natural disaster. We had Hurricane Katrina. So there are policy and non-policy reasons why we tend to have variation over time in terms of the relationship between outlays and revenues and in what kind of economy, a recessionary economy or a non-recessionary economy. As you can see, that was a rare period of time at the end of the Clinton administration when we ran surpluses. Otherwise, we've had deficits most of the time. They get big when we have major recessions or large pieces of legislation that cut taxes or raise spending. During the Great Recession, we had both. And then you can see in the projections that kind of back to an autopilot phase in the projected area where you can see that revenues are projected to rise naturally as a share of GDP, but spending is rising just as fast, if not faster. And these projections are based on current law, by the way. So it's not anticipating any future extensions of tax cuts, for example, that may very well come up. Here's the historical chart of deficits and net interest. Again, it's as a share of GDP. Here, we're not just showing the total deficit, which is the black dotted line, but we're also showing what's called the primary deficit or surplus, which is without counting interest costs. So just the excess of direct spending over revenues, so that you can see the contribution of net interest costs, which are the blue bars, to add to the primary deficit, the red bars, which adds up to the total deficit or the black dotted line. From 2009 on, you can see that net interest has been relatively small since the Great Recession relative to the total deficit. So those blue bars of net interest costs are relatively small compared to the primary deficit amounts, the red bars. And that is largely because interest rates have been quite low even over the time before the Great Recession during the George W. Bush administration. And we'll talk a little bit about the different factors that led to those relatively low interest rates. Still, the point is the red bar is sort of the principal of the debt. And you can see that we've been adding to the principal of debt pretty quickly because those red bars are pretty big. It's not just due to interest costs. So here's a picture of deficit and interest rates, what we've seen at the surface. These are purely historical charts now. This is federal surplus or deficit as a share of GDP in the top graph. And in this graph, a negative number below that thick horizontal line, those are deficits. And so you see again in this chart, only when it dips above that horizontal axis are we dealing with that brief period of surpluses at the end of the Clinton administration. And we see that in the 80s, going back to like 1980, we were used to seeing fairly large deficits. That's a negative, fairly large negative number as a share of GDP. So deficits in the early 80s were running about 5% of GDP. And we were seeing interest rates in the teens. But as you go through over time, when we get to the 1990s, when the Clinton administration was trying to reduce deficits quite a bit actively through tax increases and spending restraint, you see that deficits turn to surpluses. And in general, the trend line between like 1990 and 2000 shows if you drew a line through those wiggles, it would be a slight downward trend in interest rates, but not a dramatic relationship. And that downward trend, however, continued beyond the end of the Clinton administration, even as the surpluses went back to deficits, even as deficits became even bigger and very large during the Great Recession, which is that last recessionary band that you see at the end of, in the 2007 to 2009 period. So interest rates appear to not have that positive relationship with deficits that we were used to seeing and used to talking about as economists in past decades. In the 1990s, as deficits declined and turned to surpluses, circled here, we saw that interest rates came down, but then we can't really explain the continued decline, at least, the total effect that we see at the surface. One of the main factors affecting interest rates is the supply of capital relative to the demand for capital. And the supply of funds has been pretty steady. We haven't faced the crowd out, like the excess demand for the savings of U.S. households. We haven't seen so much stress on that supply because we've been able to continue to get a supply of capital from abroad. So when Americans weren't saving very much, we were lucky that, especially in the aughts during the George W. Bush administration, there was still a lot of global savings going around, and some countries were actually running savings gluts. And so what that meant is that there was a lot of capital from abroad that investors from abroad wanted to hold in treasury debt, because treasury debt is considered a very safe investment. And so because of that, we were able to keep interest rates low even as we were increasing our debt as a share of GDP, because more and more of that debt was being financed by foreign investors. And you can see that in 1990, this chart shows that foreign holdings of federal debt were 19% of total debt held by the public. But by 2018, it was 40% foreign holdings. And there were periods of time, you can see that that blue curve really kind of accelerated during the period of time during the George W. Bush administration, where I will show you in a bit that we were really counting on foreign holdings financing almost every additional dollar of debt that we accumulated during that period. So a quick story about, what happened during each administration. So during the Clinton administration, we went from deficits to surpluses. There was what I call the Ross Perot effect, from Ross Perot having campaigned to be president against George H.W. Bush and Bill Clinton. And even though he eventually, wasn't really a threat to win the presidential election, he certainly had an effect on Clinton's policy stance, because Ross Perot was a big deficit hawk and talked about the need to reduce our reliance on foreign held debt. And that ended up resonating with at least Clinton's economic advisors. It probably led Clinton to not go through with his campaign promises for middle-class tax cuts, and instead, by 1993, he had proposed and signed a tax increase bill. And so deficits came down in large part because of tax increases, but there was also spending restraint because of a 1996 welfare reform bill and the end of the Cold War, where we weren't needing to spend as much in terms of military spending. And we had something that Alan Greenspan had referred to as irrational exuberance of the stock market, because the tech sector was really heating up. And there was that very quick rise in the value of stocks in the tech sector led to a lot of what were called revenue surprises repeated year after year in the late 1990s, where the Congressional Budget Office was consistently underpredicting the revenue that would be raised, because there was a lot of revenue coming in from taxes on capital gains and dividends, capital income taxes. So there were policy reasons, there were some economic reasons, there was a little bit of not just long-term economic reasons, but also some kind of idiosyncratic reasons like the tech bubble and the end of the Cold War that led to this quick reduction in deficits and change over into actual surpluses. The budget projections when Clinton left office for the next 10-year budget window were for $5.6 trillion in surpluses over the 10-year budget window, which seems pretty amazing now. There was a confluence of factors that on net tended to reduce interest rates over time. So not just deficit reduction, but there were these other factors that also tended to hold down interest rates. There was the maturing of the baby boomers, like the aging of the population, which tends to increase demand for bonds or safer investment relative to stocks. And that tends to push up the price of bonds and push down the yield or the interest rates on bonds. And so that demographic factor tends to hold down interest rates. And also the boom and then followed by the bust of the stock market also led people to fly to safety, to seek safety and seek investments in bonds over stocks by the end of the Clinton administration. In the George W. Bush administration from 2001 to 2009, of course, Bush came in with having campaigned on big tax cuts, and those tax cuts were passed pretty quickly after Bush took office in 2001. So in the spring of 2001, the so-called Bush tax cuts were passed. There were more tax cuts that were passed in 2003 that focused on capital gains and dividend taxes. So those reduced revenues, therefore increased the deficit. On top of that, we had 9/11, we had a new Medicare prescription drug program, so increased spending. We had the Iraq War, and we had Hurricane Katrina, and all those factors tended to contribute to increased budget deficits. We had generally good economic conditions until the financial market credit crisis that developed in 2007, which foreshadowed the Great Recession. All of that was enough so that by January 2009, the budget outlook had nearly completely flipped from what it was when George W. Bush had taken office. And actual and projected deficits over that 10-year budget window, where we had projected $5.6 trillion in surplus, had gone to $4.5 trillion in deficits over the same 10-year window. Yet interest rates stayed low because we actually had a good supply of foreign capital coming in, lots of demand to hold treasuries, a safe investment. We had accommodative monetary policy, so the Fed was helping to keep interest rates low. And we had the aging of the baby boomers, so we still had the demographic factors that tended to increase the demand for bonds and therefore hold interest rates low. The foreign capital aspect of what happened to deficits and interest rates during the George W. Bush administration was huge because during the George W. Bush administration, almost all of every dollar of additional debt that was taken out was financed by a foreign investor. So this is a chart that really drives that home. The red line is debt, federal debt held by the public. And the blue line is the change in the debt held by foreign investors, foreign and international investors. And the fact that those lines are staying so close together means that almost all, and sometimes more than all, of each additional dollar of debt was coming from abroad. And foreign holdings increased from the start to the end of the George W. Bush administration's 2 terms from 30% of debt held by the public to 48%. So to do that, we saw that the marginal effect was almost dollar for dollar for most of this period. Now, during the Obama administration, we were hit with the Great Recession. So it was started by the credit crisis and the subprime mortgage problem. When we went into the Great Recession, there are 2 things that happened to deficits. One is sort of the natural movement of deficits with economic circumstances, which is that when you head into a recessionary time and you don't change policy, so holding policy constant, you would naturally get a big drop in revenues because the economy's contracting, and you'd also get a big increase in spending because a lot of our spending is designed to be safety net spending that's supposed to help low-income households. So that happens naturally with a contraction in the economy. But then on top of that, if the government decides to engage in countercyclical fiscal stimulus, they want to try to reduce the adverse impact of the recession on the economy, then they are trying to fight the recession with deficit finance spending and tax cuts. And that's in fact what happened. We had a big fiscal stimulus bill passed in February 2009, and that caused policy to increase the deficit even beyond the economic effects on the deficit. We also had Obamacare passed in 2010. We extended most of the Bush tax cuts twice. The tax cuts were originally scheduled to expire at the end of 2010, but we extended it once, and then we extended it for a final time at the end of 2013 with the so-called fiscal cliff, which the cliff referred to if we had let them all expire at the end of 2013. And during this period of time, Obama appointed the Simpson-Bowles Fiscal Commission, which was designed to try to come up with policy options to reduce the deficit and get us on a more sustainable path. And it was designed to try to lead to a proposal that might be voted on by Congress. The Simpson-Bowles Fiscal Commission was not able to get the required hurdle that they set up for how many votes they would have had to have to put forward their policy as an actual legislative proposal. Never came through. They got a majority, but not the amount they were required to get for the up or down vote. And yet, by the time that this had come to pass, the commission had come and gone. The economy had started to recover, and so there was some natural deficit reduction as the economy started to recover. During this period of time, even though deficits were record-setting as a share of GDP, the global demand for treasury bonds actually remained very high. Despite the fragility or the what seemed like unsustainable debt levels of the U.S. government, we were still doing better than a lot of other countries were in terms of fiscal sustainability. And so even as the foreign-held share of debt did come down relative to the George W. Bush years, demographics and a globally reduced taste for risky investments also kept downward pressure on interest rates. Now, here we are in the Trump administration, nearing the end of his first term. The Tax Cuts and Jobs Act is really the big piece of legislation that the Trump administration accomplished. And what was unusual about the Tax Cuts and Jobs Act was that it was deficit financed at a time of low unemployment. We don't have the argument for deficit finance policy that we do in a time of recession. Yet, all the longer term and demographic factors that we've seen for a while in terms of things that have kept interest rates low have actually remained. So despite the fact that a lot of economists say this is not the time to run deficit finance policy, it's too big of a tax cut, too costly, it's a waste of money, it'll hurt the economy eventually, it's bad for long-term growth, we don't see the symptom on interest rates. So most of the symptom is largely undetected because it's that underlying opportunity cost of dedicating future resources and income to current consumption. So here's some observations about present conditions, both economic and fiscal. We are in an unusual present circumstance of being in such a low unemployment economy with such high deficits. And the downside of that is less about current interest rate levels and more about this lack of fiscal space, this using up of capacity, the capacity to respond to future downturns or emergencies, and also the generally reduced responsiveness of the fiscal policy system to economic fluctuations. So, we have built-in automatic stabilizers in the federal budget in that when the economy contracts, it does tend to reduce revenues as a share of GDP. When tax burdens as a share of GDP go down, that helps prop up the economy a little bit more. Also, that when the economy grows strongly, it usually results in a growth of revenues as a share of GDP and also an increase in the progressivity of the overall tax and transfer system, that we are taxing higher income households more because we have a progressive income tax structure, and we have more revenue as a share of GDP to put into investments, longer term savings and investment. So the more we try to offset that natural development of fiscal policy with the economy, the more we try to fight that, the less resilient and flexible and responsive our fiscal policy mix becomes to the needs of our economy as the conditions of the economy change. When we cut income taxes like we did with the Tax Cuts and Jobs Act, we're going to end up naturally kind of reducing how responsive the income tax, our overall tax structure is to increases in economic growth. So revenues as a share of GDP aren't going to grow as much when the economy grows. So we're not supporting growth in the size and scope of government if we are always fighting kind of cutting tax rates as the economy grows. And that's what's been going on during the Trump administration, basically. We've tended to tamp down revenues by passing tax cuts. And we also, at the same time, haven't really seen evidence that the Tax Cuts and Jobs Act led to much supply side growth in the economy. There hasn't been much evidence to suggest that the Tax Cuts and Jobs Act increased saving or investment or labor supply in the economy. So, in summary, so much can explain this picture of interest rates in general coming down over the decades and staying pretty low, very low right now. So, over the past 10 years, we've seen really exceptionally low interest rates. And that alone tells you that there are so many factors that explain why interest rates are low. And so economic factors affecting interest rates are government deficits. Yes, still government deficits have a connection to interest rates because it's a demand for capital. And with a fixed supply of capital, that will put upward pressure on interest rates. But the supply of capital is not fixed. And so there's a global stock of savings and there's a global desire to hold safe investments. And in times of economic uncertainty, like we're in a period of high economic uncertainty at the moment because of the COVID-19 virus, we are seeing that investors are going to flee to safety. They want to come out of the stock market into the bond market. That is really having an effect on keeping interest rates extremely low. And monetary policy as well has an effect. What the Federal Reserve does also has a profound effect on interest rates. So this confluence of events and circumstances has kept interest rates low even as deficits have gone up. Ultimately, what matters for interest rates is the supply, the total supply of productive capital in the global economy relative to the demand for funds for current consumption or investment. So, some cautions about what's the downside of low interest rates. Shouldn't we be happy that interest rates are so low? Well, it's great right now, but there's a tendency to make us complacent about the costs of borrowing. It leads to this fallacy of cheap or free borrowing, and people tend to forget that there's not just the interest cost of the loan, but the principal of the loan that we have to be able to pay back. And it doesn't just encourage more deficit financing, but it also tends to just reduce economic arguments and the political desire to talk about reducing longer-term deficits now. Like, it just doesn't seem like a pressing issue. And so we just don't hear a lot of the presidential candidates now talking about fiscal responsibility or any concern about the size of deficit. And when we think about what gets reported in the media, even what gets reported in the economic and policy press about deficit projections, neither the principal nor returns to missed opportunities are accounted for in explicit budgetary costs that, for example, the CBO puts out. So in a 10-year budget window perspective, when CBO talks about projected deficits, it's only looking at 10-year costs. It's not talking about the cost of current borrowing on the future economy. And so we tend to not account for those longer term costs. There is an argument that is often used lately among economists that want to say, look, we're worrying too much about deficits and debt because what matters is how high the interest rate is relative to the growth rate of the economy. If economic growth exceeds the interest rate, then the economy can theoretically keep up with the cost of deficit financing. So as long as our economic capacity grows as fast as the debt grows, we have the capacity to sustain that debt, to be able to service the cost of that debt, to be able to carry that debt, assuming a fixed stock of debt with no additional borrowing going forward. In other words, that we're not adding to the principal, which has definitely not been the case. We continue to run up deficits. This argument was one we focused on a lot in the past. Economists used to say that 3% of GDP deficits was a good target because we used to be able to count on economic growth being about 3% per year, real economic growth. But now, unfortunately, economic growth has not been keeping up with 3%. And also, by the way, deficits are larger than 3% of GDP now. And so when deficits are larger than 3% of GDP and when economic growth is below 3% of GDP, our economy is not keeping up with the growth in debt. And so debt to GDP will rise. And interest rates are low now, but unfortunately, we can't go much lower. All economists expect that as the demand for funds continues to outpace supply of funds, interest rates are going to go up. A popular theory that goes around that seems like a great magic solution, it's called modern monetary theory. It's this idea that because the U.S. can print its own currency and issue its own currency, that we are hardly constrained by funds. We don't have to worry that we don't have funds from the rest of the world to borrow because we can just create our own funds. Unfortunately, modern monetary theory is not a workaround. It can be a case for deficits when demand-side stimulus is needed, but it does not say that deficits do not have a supply-side cost in a full employment or at-capacity economy. MMT is often framed around an accounting identity about private versus public savings, as if there is an overall economy-wide budget constraint and we're simply moving money, like there's no such thing as good deficit reduction, because deficit reduction means we're taking something from the private sector and moving it to the public sector, and we haven't gained anything in the economy. But that story that all we're doing is moving money between private and public sector ignores the effects of moving that money on economic behavior. So if the private sector does something different with a dollar than the public sector would have done by saving that dollar, then it is not just moving the money, and the total effect on economic behavior and output is not fixed. So the reason why moving a dollar out of public saving and into the private sector does not imply total saving is unchanged is because we're moving a dollar. If we increase deficit financing or deficit spending, we are reducing public saving by a dollar, but private saving is not going to increase by that dollar because the household or business that receives that dollar can do whatever they want with that dollar, including consume it. They don't have to save it. I mentioned that Penn Morton budget models really focus on the supply side of the economy and the longer term, and that's why deficits really matter in Penn Morton budget model analyses. So often our analysis of proposals focuses on not just what the policy itself does to the economy, but how the policy is paid for or what we do with the revenue raised from a new tax that we're looking at. So here are a few examples of Penn Morton budget analyses that talk about the importance of the financing part and not just what the kind of first round effect of the policy itself is. We did an analysis of the wealth tax, something similar to Elizabeth Warren's proposed wealth tax. It's a new tax. The U.S. doesn't currently tax wealth except for, small amounts of wealth through the estate tax. A wealth tax would be a new tax base. It would be a pretty small tax base because it would be focused on only the very wealthiest of households, billionaires. And therefore, it translates to a pretty high effective tax rate on capital income. So income is the flow, wealth is a stock, and so even a small percentage rate on wealth translates into a very large percentage effective tax on income. As a result, it has pretty significant disincentive effect in the Penn Morton budget model on saving and capital accumulation. And because of that, we show that the macroeconomic effect would be to reduce GDP. not by a huge amount, but you can see that this is a percentage reduction in the level of GDP that over the next few decades, it would reduce by almost 1% of GDP because the capital stock is reduced more significantly. And so this is despite we took the revenue and we simulated as reducing deficits. But in this case, because the effective tax rate on capital income is so high, the disincentive effect on capital accumulation ends up outweighing the positive effect on the capital stock of reducing deficits. And that's why the GDP effect in total, even with deficit reduction, is negative. The next policy we'll look at is tax reform, what we call tax reform 2.0. It's what if we extended the tax cuts in the Tax Cuts and Jobs Act, where the individual income tax cuts actually are set to expire in a few years. What if we instead extended those permanently over at least the rest of the 10-year budget window? That would cost about $400 billion over 10 years. And despite the rate cuts, which can have positive incentive effects on the supply of capital and labor, the fact is that that is a pretty significant increase in deficits. That reduces national saving, and that effect ends up outweighing any positive incentive effect of rate cuts. So this is sort of the opposite scenario of the wealth tax case. Another policy is to broaden the tax base. This is a proposal to eliminate itemized deductions. And actually, no one is actually proposing this right now. No congressperson is proposing this right now. But it's an example of a fundamental tax reform where we take a large hole in the existing tax base and we fill it in. So if we were to eliminate itemized deductions, it broadens the base. It tends to raise more revenue from higher income households. And so that's a progressive tax increase. It raises a lot of revenue, $2.1 trillion over 10 years. And that is a huge deficit reduction effect. And it's a rather efficient way of raising that revenue. So it increases the capital stock significantly, and it increases labor supply and GDP as well. So that is a positive macroeconomic policy. And then finally, the carbon tax is an example of a new tax base. It's a new non-distortionary tax with an environmentally motivated tax base. If we tax carbon at $30 per ton, it would raise $1.6 trillion over 10 years. It would discourage consumption and increase capital formation, which, remember, in a supply-side model is very good for GDP. So it discourages consumption, increases savings, increases the capital stock, increases GDP by 2050 by 2.2%. So in summary, Penn Wharton budget models focus on the measurement of the longer-term effects of policy on a full employment economy, in which the only way to increase the size of the economy is by increasing the supply side of the economy. Economists like to use different kinds of models, not just these supply side models, to estimate the effects of policies on the economy. And in particular, there are a lot of models that are used to forecast the shorter term economy and that are used to project or predict the effects of stimulus policy on the shorter term demand side of the economy. This is not what our models do. Because Penn Wharton budget models are built from the individual household level up, though, we are able to consider additional economic goals for fiscal policy apart from just the longer term supply side aggregate goals of increasing capital stock, labor supply, and GDP. We're able to look at the effects of policies on the income distribution, so distributional considerations. And that is what makes us unique, is we're not just predicting macro or aggregate effects, but we're able to look at effects on different types of households, which means that our macro models are much more useful in terms of evaluating the effects of policies on economic and social well-being. And there's more that we'll cover on this in our third core lesson through the certificate program, which focuses on economic modeling. So to summarize, why do deficits still matter? So even in an economy with very low interest rates, deficits immediately and certainly reduce current saving and future wealth and economic capacity. And the problem is there's no promise of making up for it later. So if we don't account for a policy's longer term effects on the economy, it's hard to determine whether deficit spending, deficit financing is actually a good deal. Is it worth it? It's true that we have low interest costs now, but we need to make sure that the trade-offs for lower economic growth from reduced saving are going to be worth it in the future. And because the true consequences of deficits are difficult to see and comprehend by the public and policymakers, I think deficit financing misleadingly lowers the bar on which policies are worth their costs. So we tend to ignore the cost of deficit financing. And so it means that the benefits, the perceived benefits of policy, don't have to be as high either. And so private interests or shorter term, interests for things that are immediately obvious as things that people benefit from deficit finance policies will tend to get overvalued relative to the social values, which tend to be about longer term things. Current deficit financing raises the economic costs and reduces the political likelihood of future deficit spending. And that means that there is a crowd out that happens, even if it's not explicit crowd out in the form that's showing up in higher interest rates that signals that there's a price to it. I feel like there's an invisible crowd out that occurs that operates more through the political willingness of policymakers to go ahead and increase the deficit when costs are not so obvious to the public. And it ends up bringing forward the amount of deficit spending we're doing now when we probably don't need it to do it now. It's not as justified now. But then in the future, when we need it more, politicians will be able to say, oh, well, too bad we don't have the money. We've borrowed enough in the past. We can't afford to borrow anymore. So deficits still matter because they reduce both perceived and real fiscal space. Deficits are not always bad. To remind you, there's good reasons if we need economic stimulus to increase demand. If we want to finance an investment for the supply side, for the longer term productive capacity of our economy that will eventually pay off in the future and could not otherwise be financed, we should take advantage of low interest rates for things that will produce a higher rate of return in the future than the interest costs that we're going to have to pay to finance it. Bad reasons, though, for deficit financing is just because politicians can get away with it. It's the easy way out. We don't have to propose higher taxes or reduce spending, and because future generations can't vote. To conclude, what's changed since the early 1990s is just the observed correlation between deficits and interest rates, and no longer do we see these obvious increases in deficits to GDP corresponding to increases in interest rates. And that disconnect does not mean that the fundamental economic relationship between deficits and interest rates has changed. It just means that so many other things affect interest rates as well. We should keep in mind that really the economic fundamentals of why deficits matter have not changed. So that concludes our talk on whether deficits still matter. Thank you for listening.